HALT, everything. Small silver investors need to see this now. What happened in the silver market during last night's trading session wasn't just volatility, it was a warning shot. A $100 threshold approached, and then something unusual occurred. Paper contracts flooded the market, while physical borrowing costs spiked simultaneously, two opposite signals at the exact same moment. When markets speak in contradictions, someone is hiding something. And what's hiding beneath this price action could redefine everything small investors think they know about silver. The question isn't whether you're ready for what comes next. The question is whether you'll even see it coming. Welcome to John Analyst, where we don't just report the news, we decode the patterns the market doesn't want you to see. Now, if you've been following global markets for a while, if you've lived through a few cycles and learned that things aren't always what they seem, then do me a favor, subscribe to this channel. Think of it this way. You wouldn't leave a serious conversation halfway through, would you? So don't leave this channel without subscribing. And before we go further, I'm curious, where in the world are you watching this from right now? Drop your location in the comments. Let's see how global this community really is. Now, let's get into what the overnight silver move is actually telling us. In the early hours of a seemingly ordinary trading session, something peculiar unfolded in the silver market. The price had been climbing steadily, inching closer to a number that makes traders nervous and headlines inevitable. $100 per ounce. A psychological barrier, a round number that carries weight far beyond its numerical value. But just as silver approached this critical threshold, the market did something it rarely does without reason. It reversed violently. Within minutes, selling pressure flooded the exchanges. Contracts were dumped. Prices retreated. To the casual observer, this looked like simple profit-taking. Traders cashing out before a major resistance level. Nothing unusual. But those watching the deeper mechanics of the market saw something else entirely. They saw a contradiction. While paper silver contracts were being sold aggressively, the cost to borrow physical silver spiked sharply. This is not normal. In a healthy market with abundant supply, when selling pressure increases, borrowing costs typically remain stable or even decline. There's plenty of metal available, no stress, no urgency, but that's not what happened here. Instead, lease rates, the cost institutions pay to borrow physical silver, jumped noticeably. This creates a strange picture. Paper says, sell. Physical says, pay more. Two opposite signals occurring simultaneously. When markets speak in contradictions like this, someone is managing pressure that the public cannot see. This divergence reveals something critical about silver's current structure. For years, the silver market has operated under a unique characteristic that separates it from most other commodities: concentration. Unlike gold, oil, or agricultural products, where thousands of participants create distributed price discovery, silver has historically been dominated by a small group of large institutional players, holding unusually concentrated short positions. This isn't speculation, this is documented reality. Regulatory filings and market data have repeatedly shown that a handful of banks carry short exposure in silver that dwarfs comparable positions in other markets. Why does this matter? Because concentration changes everything. In a distributed market, price reflects the collective wisdom or panic of many independent actors. But in a concentrated market, price can be influenced through narrower channels of control. A small group with large positions can create selling pressure that looks organic, but is actually strategic. The question that serious analysts ask is simple. Why would anyone maintain such concentrated short exposure in silver for so long? The standard explanation is hedging. Banks hedge their client exposures. They manage risk. This is normal financial practice. But silver is not just another industrial metal. It occupies a unique intersection. On one side, it's indispensable for modern industry. Electronics rely on its conductivity. Solar panels require it for efficiency. Medical devices use it for antibacterial properties. High-performance defense systems incorporate it because no substitute matches its thermal and electrical characteristics under extreme conditions. This makes silver strategically important, not just economically valuable, but operationally critical. And here's where incentive structures become relevant. If silver is embedded in systems that nations depend on, then stable, predictable pricing becomes preferable to chaotic spikes. Volatility creates supply chain risk. Volatility creates cost uncertainty. Volatility creates geopolitical vulnerability. So there exists a natural preference among certain institutional players and sovereign interests for silver to remain contained within a manageable range. This preference isn't conspiracy, it's strategy. And strategy can work for years, until the structure underneath it begins to crack. The crack appears not in headlines, but in behavior, specifically delivery behavior. In recent months, something unusual has been occurring in silver futures markets. More contracts are standing for physical delivery, even in months where delivery activity is typically quiet. This matters Because futures contracts exist primarily as financial instruments. Most participants settle in cash. They never intend to take possession of metal. But when an increasing number of contracts demand physical settlement, it signals a shift in confidence. It signals that certain players no longer trust paper promises. They want metal in hand. And when this behavior expands, it becomes a stress test for the entire system, because paper markets can create the illusion of abundant supply. A trader can sell a contract with a keystroke, but moving physical metal from a vault requires time, logistics, and actual inventory. If delivery demands continue rising while available, inventories do not. The gap between paper pricing and physical reality begins to widen. And that widening gap is precisely what the overnight lease rate spike revealed. The market was whispering something the price chart couldn't show. Physical is tight. Supply is not as comfortable as paper pricing suggests. And someone, somewhere, needed the price to step back from the edge before that tightness became impossible to manage. This is not the behavior of a market in balance. This is the behavior of a market under strain. And strain, when ignored, eventually breaks. There's a fundamental truth about commodity markets that most investors never fully grasp. Price is not always reality. Price is often perception. And in silver, perception has been carefully managed for longer than most realize. But perception has a weakness. It requires cooperation. The moment too many participants stop cooperating, stop trusting the paper game, stop accepting cash settlement instead of physical delivery, the entire illusion begins to unravel. And right now, that unraveling has quietly begun. Consider what's happening beneath the surface. Silver futures contracts are designed with a choice built into them. At expiration, the holder can either accept cash settlement or demand physical delivery of actual metal. Historically, the overwhelming majority choose cash. It's easier, it's faster. It avoids storage costs and logistical complexity. The system depends on this preference. But lately, something has shifted. Delivery demands have increased, not just in traditionally active months, but across the board. Contracts that would normally expire quietly into cash settlement are instead standing for delivery. This isn't retail investors making emotional decisions. This is institutional capital making calculated ones. When billions of dollars choose metal over paper, it's not a whim. It's a vote of no confidence. And the market is starting to feel the pressure. One of the clearest ways this pressure reveals itself is through market structure. Specifically, the relationship between spot prices and futures prices. In a normal, comfortable commodity market, futures trade at a premium to spot. This is called contango. It reflects the cost of storage, insurance, and the time value of money. You pay more for delivery later because holding physical commodities has real costs. This structure is natural. It's expected. But when that structure flips, when spot prices begin trading above futures prices, the market is sending an entirely different message. It's called backwardation. And it means the market is willing to pay more for immediate possession than for future delivery. This is urgency. This is distrust. This is the market saying, promises about later don't matter as much as metal in hand right now. Silver has been flirting with this structural flip repeatedly in recent months. Brief episodes where spot premiums appear, moments where the normal order inverts. Each time it happens, the financial media barely notices. But those who understand commodity market mechanics recognize these moments for what they are. Warning signs. The market is testing the limits of the paper system's credibility. And here's where the story gets even more interesting. While Western exchanges show one price, physical silver in major Eastern markets trades at a persistent premium. Not a small premium, not an occasional premium. A sustained structural premium. Several dollars per ounce above what paper contracts suggest silver should cost. This creates a powerful economic mechanism. If someone can buy exposure cheaply in the West through paper markets and simultaneously sell physical metal at elevated prices in the East, they've created a one-way arbitrage. Every dip in Western paper prices becomes an opportunity. Not for speculation, for transfer. Metal flows from west to east, from paper holders to physical accumulators, from financial centers to industrial and sovereign buyers who aren't playing the trading game. They're building inventory. And once metal moves east, it doesn't casually flow back. This is where many analysts misread the situation entirely. They see a price drop and declare weakness. They see selling pressure and assume demand has collapsed. But if the physical premium in Shanghai or Mumbai or Dubai remains elevated, if lease rates stay tight, if delivery volumes continue rising, then the price drop isn't signaling weakness. It's signaling redistribution. From leveraged hands to unleveraged hands, from speculators to accumulators, from those who need liquidity to those who need metal. This distinction is everything, because a dip driven by forced selling due to margin pressure looks identical on a price chart to a dip driven by genuine demand collapse. But the underlying dynamics are completely opposite. One is temporary pressure that clears quickly. The other is structural breakdown. And right now, every piece of supporting evidence suggests the former, not the latter. Now let's talk about the $100 threshold. Why does this number matter so much? On the surface, it's just psychology. Round numbers create anchoring effects. Traders place stops around them. Media writes headlines about them. Retail investors pile in or panic out based on them. But beneath the psychology lies something more mechanical. If large institutions have carried short positions that were comfortable at $70, nervous at $85, and visibly strained at $95, then the approach toward 100 becomes existential. Because short positions in a rising market don't just lose money, they create obligation. The obligation to deliver metal if counterparties demand it. And if physical metal is becoming harder to source, if lease rates are spiking because supply is tight, if delivery demands are increasing, then defending a short position near $100 isn't about protecting profit. It's about protecting solvency. This is why the overnight selling looked less like profit-taking and more like desperation. Someone needed the price to retreat, not because of technical analysis, not because of chart patterns, but because the risk of being trapped on the wrong side of a physical squeeze had become unacceptable. And when institutions trade out of fear rather than strategy, the market stops behaving rationally. It behaves violently, which is exactly what small investors need to understand. The game has changed. This is no longer just about price. It's about delivery. It's about trust. It's about whether the paper market can continue functioning. When too many participants stop believing in paper and start demanding metal. There's a moment in every bull market that separates survivors from casualties. It's not the initial move up. It's not the euphoria phase. It's the moment when the rules change overnight. And in silver, that moment arrives through a mechanism most investors don't see coming: margin requirements. Two words that sound boring, two words that destroy portfolios. Here's how the trap works. When silver begins a sustained upward move, excitement builds. Traders who've been waiting for years suddenly feel vindicated. New participants rush in, chasing momentum. And because silver futures offer leverage, because a small amount of capital can control a large amount of metal exposure, the temptation becomes irresistible. Why buy 10 ounces of physical silver when you can control 1,000 ounces through contracts? The math looks brilliant until it doesn't. Exchanges that facilitate futures trading have a responsibility. They must ensure that all participants can meet their obligations. When volatility increases, when price swings become larger and more frequent, exchanges respond by raising margin requirements. This means traders must post more cash to maintain the same position. Overnight, the rules shift. A position that was fully funded yesterday suddenly requires additional capital today. And here's where the mechanical brutality begins. If a trader cannot post the additional margin, the position gets liquidated automatically, not at a price the trader chooses, not when technical levels make sense. Immediately, at whatever price the market will bear in that moment. This forced selling creates a cascade effect. One trader's forced liquidation pushes the price down. That price drop triggers margin calls for other leveraged traders. Those margin calls force more liquidations. More liquidations push the price down further. The cycle feeds on itself. And the cruelest part? The underlying fundamentals don't have to change at all. No new silver mine needs to open. No industrial demand needs to collapse. No geopolitical stability needs to return. All that needs to happen is enough leveraged traders getting pressured simultaneously. This is what market insiders call shaking the tree. It sounds poetic. It's actually mechanical violence, and it serves a very specific purpose. Large institutions with deep capital reserves don't use leverage the way retail traders do. They don't get margin calls. They don't get forced out. They sit patiently, waiting for exactly these moments of forced liquidation. Because when someone is selling not by choice, but by obligation, the buyer gets to name the price. This is wealth transfer dressed up as market volatility. And it happens in every commodity bull market without exception. Silver is particularly vulnerable to this dynamic because of its price volatility. A $5 move in gold might represent 2%. A $5 move in silver can represent 7 or 8%. That amplified volatility triggers margin pressure faster and more frequently, which means the shakeouts in silver are more violent, more sudden, more psychologically devastating. Traders watch their positions cut in half in days. They watch months of gains evaporate in hours, and they make the fatal mistake of assuming the bull market is over. But here's what the data actually shows. When these forced liquidation events occur, when margin hikes create cascading sell pressure, the recovery is often swift and aggressive. Not because of technical patterns, because the fundamental imbalance hasn't changed. The physical tightness is still there. The delivery stress is still building. The Eastern premiums are still elevated. All that happened was a temporary clearing of leveraged positions. And once that clearing is complete, once the weak hands are flushed out, the price often snaps back with surprising violence. Because the patient capital that was waiting on the sidelines, the capital that doesn't use margin, the capital that understands this game, steps in and buys aggressively. This is why experienced precious metals investors focus on one principle above all others: no leverage. Not because leverage can't amplify gains, but because leverage guarantees you'll be forced out at exactly the wrong time. The market doesn't just test your thesis, it tests your ability to survive the test. And if you're using borrowed money to amplify your position, you've already failed that test before it begins. Now let's discuss another layer of this system that most investors never consider: counterparty risk. When someone buys physical silver and stores it personally, they own metal. Full stop. No counterparty. No intermediary. No institution standing between them and the asset. But when someone buys silver through exchange-traded funds, certificates, or allocated accounts, they've introduced layers. Who actually holds the bars? Who verifies they exist? Who audits the inventory? Who guarantees delivery if thousands of holders demand physical settlement simultaneously? These aren't paranoid questions. These are structural questions. And in times of market stress, structure matters more than promises. History offers uncomfortable lessons here. Major financial institutions have been fined multiple times for manipulative practices in precious metals markets: spoofing, layering, quote, stuffing. These aren't conspiracy theories. These are documented violations that resulted in penalties. But here's the disturbing part. The fines were paid. The institutions continued operating. The same players remained in the same markets, which suggests that for some participants, the fines were simply a cost of doing business, not a deterrent, a receipt. This reality forces a critical question. If large institutions have been willing to pay penalties to maintain certain market behaviors, what happens when the stakes get higher? When physical delivery stress reaches levels that threaten solvency rather than just profit margins? The answer is uncomfortable but necessary to consider. Desperate institutions don't follow normal risk management protocols. They follow survival protocols. And survival protocols involve doing whatever is necessary to close out dangerous positions, even if that means selling aggressively at odd hours, even if that means creating temporary price collapses, even if that means testing the resolve of every small investor holding silver. Because if they can trigger enough panic selling, if they can force enough weak hands to liquidate, they can buy back their short positions at lower prices and escape the trap. But this strategy has a fatal flaw. It only works if physical holders panic. And increasingly, they're not panicking. Instead, they're watching the divergence. They're watching paper price get smashed while physical premiums hold. They're watching lease rates spike while Western exchanges show weakness. They're watching delivery volumes increase while mainstream media declares the rally over. And they're making a different calculation. They're holding, or better yet, they're buying more. Because they understand something that leveraged traders often forget. In a structurally tight physical market, every panic-driven dip is not a warning. It's an opportunity, but only for those who can survive the pressure. Only for those who didn't overextend. Only for those who built positions they can hold through volatility. This is the difference between gambling and strategy. Gamblers use maximum leverage and hope for smooth rides. Strategists use zero leverage and prepare for chaos. And in silver, chaos isn't a possibility, it's a guarantee. Understanding a problem is not the same as solving it. Many investors can describe what's happening in silver. Few know what to do about it, and fewer still have the discipline to execute when the pressure arrives. So let's build a framework, not for predicting the future, but for navigating uncertainty without self-destruction. The first principle is simple but critical. Stop watching price in isolation. Price is the most visible metric. It's also the most manipulated. Instead, watch 3 underlying indicators that reveal what price cannot hide. Indicator 1, the spot futures spread. This tells you whether the market is comfortable or urgent. In normal conditions, futures trade above spot. You pay extra for future delivery because time has cost, storage has cost, insurance has cost. This is contango, and it's the natural state of commodity markets. But when spot begins trading above futures, when the market pays more for immediate metal than future delivery, you're witnessing backwardation, and backwardation is not normal. It's the market screaming, "We don't trust promises, we need metal now." When silver flashes backwardation, even briefly, it's a warning that physical availability is being questioned, not by conspiracy theorists, by market participants voting with billions of dollars. Indicator 2, lease rates. This is the cost to borrow physical silver from those who hold it. In a comfortable market with abundant supply, lease rates sit near zero. There's so much available metal that borrowing it costs almost nothing. But when lease rates spike suddenly, when they jump from fractions of a percent to meaningful levels, the market is revealing something critical. Physical supply is not as comfortable as it appears. Someone, somewhere, needs metal urgently, and they're willing to pay a premium to borrow it. This is not speculation. This is measurable stress. Indicator 3, physical premiums in major global hubs. Watch what silver costs in Shanghai, Mumbai, Dubai, and Singapore, not what the paper contract says it should cost. What it actually costs to buy and take possession. If Western exchanges show falling prices, but Eastern premiums remain elevated or even increase, you're watching a transfer, not a collapse. Metal is moving from weak hands to strong hands, from speculators to accumulators, from regions that trade silver to regions that consume it. This is a one-way flow, and one-way flows don't reverse easily. Now, here's how to use these three indicators together. If silver's price drops $10 in a week, but the spot futures spread stays tight, and lease rates remain elevated, and physical premiums hold firm, then the price drop is leverage being cleared, not demand dying. It's paper pressure, not physical reality. But if price drops and all three indicators relax simultaneously, if contango returns, lease rates collapse and premiums evaporate, then the fundamental story may have changed. That's the difference between a shakeout and a reversal. Most investors can't tell them apart because they only watch price. But price lies. Structure doesn't. The second principle is equally important. Understand the failure to deliver threshold. Because there's a line in every futures market that changes everything. That line is drawn when a participant who is obligated to deliver physical metal cannot. When contracts demand settlement and the metal doesn't exist, or worse, exists but cannot be sourced in time. This is not a hypothetical scenario. It has happened in other commodity markets. And when it happens, the conversation shifts instantly, from price speculation to systemic risk, from trading opportunity to crisis management, because futures markets are built on trust. Trust that obligations will be met, trust that delivery can occur, trust that the paper system is backed by physical reality. The moment that trust breaks, the moment someone defaults on delivery, the entire structure comes into question. And questioning the structure creates panic, not retail panic, institutional panic, the kind that forces emergency meetings, the kind that triggers regulatory intervention, the kind that makes headlines for weeks. Silver hasn't reached that point yet, but the indicators suggest it's moving closer. Delivery volumes are rising. Lease rates are spiking. Physical premiums are persistent. Inventory levels relative to open interest are tightening. These are not the characteristics of a market with comfortable supply. These are the characteristics of a market under increasing strain. And strain, when ignored, eventually breaks. The third principle is about position construction. How you build exposure matters as much as whether you have exposure. Many investors approach silver with an all-or-nothing mentality. Either they're fully in or completely out. This approach guarantees emotional decision-making, because when volatility arrives, and volatility always arrives in silver, the all-in investor panics during dips. They sell at the worst possible moment, not because their thesis changed, but because their position size was too large to emotionally survive the drawdown. A better approach is scaling. Build a core position that can be held indefinitely. Physical metal that sits outside the banking system. Metal that doesn't generate margin calls. Metal that doesn't require daily monitoring. This core position is insurance. Insurance against monetary instability. Insurance against geopolitical chaos. Insurance against the paper system failing. Then, if appropriate, layer tactical positions on top. Smaller positions that can be traded around volatility. Positions that can be reduced during euphoria and added during panic. Positions that allow participation without risking the entire thesis. This structure provides flexibility without abandoning conviction. It allows someone to survive the shakeouts that destroy over-leveraged traders. Because the reality is simple. Silver bull markets are not smooth. They're violent, chaotic, psychologically brutal experiences. Even when the long-term thesis is correct, the short-term path is designed to destroy confidence, designed to trigger fear, designed to force exits at exactly the wrong time. The market tests resolve constantly, not through rising prices, through falling ones. The fourth principle is about recognizing who your competition is. Small investors are not competing against other small investors. They're competing against institutions with unlimited capital, no margin requirements, and direct access to physical supply. These institutions don't care about $5 moves. They care about structural position. And when forced liquidation events occur, when margin hikes create cascading sell pressure, these institutions are the buyers. They wait patiently for retail panic. They wait for exchange rule changes to pressure leveraged longs. They wait for headlines declaring the bull market dead. And then they accumulate. Not emotionally, mechanically. Understanding this dynamic changes everything, because it means that dips in a structurally tight market are not failures. They're features. They're the mechanism through which metal transfers from weak hands to strong hands, from impatient capital to patient capital, from those who need liquidity to those who need assets. And here's the final uncomfortable truth. If physical silver is truly becoming scarce relative to paper claims, if delivery stress is truly building behind the scenes, if the concentrated short positions are truly trapped near critical price levels, then the next major move won't be announced. It will simply happen. One day, the market will gap, not because of news, because the structure finally broke. And when that gap occurs, those holding physical metal will be fine. Those holding leveraged paper positions might be fine, But those who panic sold during the shakeout, those who abandoned their thesis during forced volatility, those who mistook temporary price pressure for permanent trend reversal, will watch from the sidelines, wondering why they didn't hold, wondering why they let fear override logic, wondering why they traded like the crowd instead of thinking like the institutions. Silver doesn't reward impatience. It doesn't reward leverage. It doesn't reward emotional decision-making. It rewards those who understand structure over price, those who build positions they can hold through chaos, those who recognize that in a manipulated market, the manipulation eventually breaks. And when it breaks, the move is never gentle. So the question isn't whether silver will reach $100. The question is whether investors will still be holding when it does, because the market will test them repeatedly, violently, without mercy, and only those who prepared for that test will survive to see what comes after.